Hello, economics students. Over the past several class periods, we've been looking at GDP, Gross Domestic Product, and we've learned quite a bit about what GDP is composed of and the percentages of each of the elements of GDP. Today we're going to continue looking at GDP, but we're going to calculate it in a different way. And to get started, I want to ask a question. When we've been looking at GDP so far, have we been looking at what we as a nation spend our money on, or are we looking at what we make our money from? Well, let's think about that answer or that question. What we've looked at thus far in GDP is consumer spending or personal consumption, plus investment, plus government spending, plus net exports, and that is what constitutes GDP. But if you think about this equation that you're looking at, this is what we're spending our money on. We're spending our money on our consumer spending. We're spending our money on investment or government spending. We're spending our money on net exports. That is, we're getting money that is being spent overseas on what we're producing. And that can oftentimes be looked at as an equation, C plus I plus G plus EN for net exports equals GDP. This we call the expenditure approach to GDP. Again, this is looking at GDP based on what we spend our money on. But we can also calculate GDP by seeing what we earn our income from. So this is kind of the opposite way of looking at GDP and the money that is included in GDP. So what I want to do today is take a look at the income approach to GDP. Thus far we've been looking at the expenditure approach. So the income approach is a little bit more complex than the expenditure approach. We're going to kind of muddy up the water a little bit by looking at the income approach, but it is something I think that we need to at least be familiar with. And those of you who would later become either accountants or economists would need to be familiar with this income approach to gross domestic product. So how do we reflect GDP in our income? There's several factors that we make our money from, which are direct contributors to GDP. First of all, employee compensation. When you get a job and your employer pays you, that is your employee compensation. That money that you're receiving as pay could be considered a part of the GDP. Also rent. When you rent an apartment, that money that you're paying for your rent would be included in GDP. If you go to see the Chicago Cubs and there's no parking around that Wrigley Field, so you go and pay rent to someone to park in their yard to watch a Cubs game, that would also be money that would contribute to the GDP. Interest. When you receive interest on your savings, that would be GDP. If you have to pay interest to the bank, that would also be considered a part of the GDP. Proprietor's income. A proprietor is someone who owns his own business. A small business that is owned by a single individual, or in this sense it would also include partnerships. It would really be anything other than a large corporation kind of thing. Income that a proprietor receives, a business owner receives, would be included in GDP. Corporate profits are also included in GDP, and notice here I'm showing what we're going to count as corporate profits. We're counting corporate income tax as a contributor to GDP because the income tax that a corporation pays is based on what that corporation has earned. It's based on its income. Dividends are earnings that a company makes that actually then is shared with their stockholders. We've talked about dividends as we've played the stock market game. And also retained earnings. Retained earnings are the remainder of the profits that the company has after they've paid their corporate income tax and paid out dividends to shareholders. The rest is retained earnings. Those retained earnings, by the way, are generally fairly comparable to the investment part of the expenditure approach of GDP. Taxes on production and imports are also a part of the income approach. Taxes on production, we don't have a lot of this in the United States, but in other countries they have oftentimes something called a value-added tax. The value-added tax is a tax that's applied on each stage of the production of a product. We don't do that here in the United States too much. Instead, we use a sales tax. It's not quite the same thing, but a production tax, also called a value-added tax in many countries. And then taxes on imports, we call those tariffs. When we import things from overseas, typically there's a small tariff applied to the items that we're bringing in from countries overseas. We'll get into that more as we get into international economics. Then we have to subtract out something. Americans are receiving income from production that's actually taking place overseas. So if an American owns, for example, stock in Nike, Nike makes a lot of their shoes overseas. And so Nike shareholders are receiving income from production that's actually taking place overseas. We want to subtract that out because the whole purpose of GDP is to measure production within a country. So if we're earning income from production that is outside of the United States, we have to factor that out. So we call that the net foreign factor income, which is a subtraction from the income approach of GDP. Then we need to add something called consumption of fixed capital. In accounting terms, that's oftentimes called depreciation. We haven't gotten to that yet in accounting class, but we will before long. But consumption of fixed capital, what does that mean? If a company buys a machine, for example, and the anticipated life of this machine is 10 years, and let's say that machine costs $50,000. Well, we need to amortize that $50,000 over the life of the machine. And if we think that machine is going to last 10 years, then we would say that every single year of this $50,000 machine, we're using up $5,000 of the machine. So when we're looking at the income approach of GDP, we're going to look at the consumption of fixed capital. That is the consumption of that $50,000 machine that we purchased that's going to last 10 years. So we're going to add $5,000 each year of that 10 years to the GDP, to the income approach of GDP. We will not add the full $50,000 at one time, because that $50,000 would just be, in that case, contributing to just 1 year. But this machine is going to contribute to GDP over 10 years, so we need to amortize that out over a 10-year period. So $5,000 per year. We're also then, the last item is going to be the statistical discrepancy, and this is sort of a fuzzy number, and I'll give you an example why this number might be necessary. Sometimes we make incorrect assumptions. So for example, when I said that consumption of fixed capital on that $50,000 machine is going to be $5,000 per year over a 10-year period, it's quite possible that after 10 years that machine still has value. And so our calculation has been a little bit off if that machine still has value after 10 years, or perhaps it became obsolete before 10 years. We have to take that into account, and that's going to go into the statistical discrepancy to fix the error in our calculations. So that's what that's all about. The statistical discrepancy can also be a part of some of the other factors that you see here. Again, there are some assumptions made in this calculation, and we need to make sure that we take those into account. Finally, I want to talk about transfer payments. Transfer payments are income received from those who have earned the income to those who did not earn the income. Let me restate that. We receive income from our productivity, but then we transfer our income to someone else. Those are called transfer payments. And that would include things like your Social Security income. When you retire, you receive Social Security income. That's basically your retirement income. You are not earning that income. Someone else is actually working and producing things, and they are paying a Social Security tax, and then that Social Security tax that the worker is contributing into this Social Security fund is then transferred to you. Okay, so you did not earn that money. Your work today is not earning the income from Social Security that you earned today, because the Social Security recipient is not working. So that's a transfer payment. Welfare would also be included in that. If someone is out of a job and they are receiving government welfare so their family doesn't lose their home and they won't starve, that's a transfer payment from those who are earning income and paying taxes, and then those taxes are going to provide income for those who have no income. That's a transfer payment. Same thing with disability income. If you were hurt on the job, you can no longer work. Our society doesn't want you to starve or lose a home, so we provide some disability income for those who are unable to work. Those who do work are then earning money that is actually going to be transferred to those who can no longer work because of the disability. Again, transfer payment. Unemployment compensation is the same thing. If you lose your job, again, we don't want you to starve. We don't want you to lose your home while you're temporarily unemployed, so you will receive compensation from those who are working and earning income. So the question is, would this kind of income transfer payment contribute to GDP? If we're looking at the income approach to GDP, a transfer payment, it's important to know what these are, and they do not contribute to the GDP. And if you think about it, that makes sense, because you've already included that income in the employee compensation or proprietor's income that we did include in the income approach to GDP. If we include transfer payments, then we would be double counting that money. So transfer payments, I want you to know what they are, but do understand that they do not contribute to the income approach to GDP. And with that, we're going to stop this presentation. There is an assignment, I believe, for you in Canvas, so make sure you check that, and we will talk to you later.